You've probably seen it flash across the news, especially when the markets get a little wild. It's the VIX, and everyone calls it the market's fear gauge. But what on earth is it actually measuring? Let's pull back the curtain on one of the most watched numbers in all of finance.
So, what even is this fear gauge? I mean, can a market actually be scared? How could one single number possibly tell us what thousands of investors are feeling? Well, let's dive in.
You see it everywhere. It's on your screen, every analyst quotes it, and while its nickname is simple, fear, the real story of what this number is measuring is actually way more interesting.
To really get the VIX, we have to start with that nickname. Officially, its name is the SIBO Volatility Index, which is, a bit of a mouthful. Fear gauge is just what sticks, and as we're about to see, there's a really good reason for that.
And listen, this isn't just some casual slang people throw around. We're talking the Wall Street Journal, Barron's, CNBC, the heavy hitters. They all use this exact term. It's become totally baked into the language of the market.
What's really crucial to understand is that the VIX hasn't just stood still. It's evolved. Back in 2003, it made a huge leap, going from tracking 100 stocks to the much broader S&P 500. That gave it a way more accurate picture of the market. Then, in 2014, another tweak made its 30-day forecast even sharper. It's constantly being refined to be a better, more useful tool.
And all those updates and refinements really point to the VIX's main purpose. See, it's not about what just happened in the market, it's a forecast. It's the market's collective attempt to predict the future.
Now, to understand that forecast, you have to get the concept of volatility. Put simply, volatility is just the market's expectation of how big the price swings are going to be. A high VIX doesn't automatically mean the market's going to crash. It just means traders expect it to move a lot. Think of it like predicting turbulence on a flight, not whether the plane is going up or down.
This right here makes the difference crystal clear. The S&P 500 index, that's the rearview mirror. It tells you what already happened. The VIX, on the other hand, is the crystal ball. It's trying to predict what's coming over the next 30 days. One is a report card, the other is a weather forecast.
And that weather forecast analogy is really perfect. The VIX is basically saying, hey, we're expecting calm seas ahead, or you might want to batten down the hatches, a storm could be brewing. It's that 30-day outlook for market choppiness.
So if the VIX is a forecast, what data is it looking at? What are the actual ingredients that go into making this prediction? Come on, let's look under the hood.
The secret sauce here isn't stocks, it's options. The VIX looks at the real-time prices of thousands of S&P 500 options. That includes puts, which are basically bets the market will fall, and calls, which are bets it will rise. And here's the key. The more that people are willing to pay for these options, the bigger the future price swing they're expecting. So it's like a snapshot of the market's collective guess about what's next.
And all of that incredibly complex data, we're talking thousands and thousands of options prices, gets crunched down and distilled into one single number. And that number represents the expected volatility for the next 30 days.
Okay, so let's talk about the recipe. How does the SIBO actually turn all of those different option prices into that one VIX number that we see on our screens?
The official formula is, well, it's pretty intense. It was definitely designed by some very smart financial theorists for professional traders, not exactly for the rest of us.
Yeah, take a look. That's the actual formula. But please, don't let your eyes glaze over. I promise, you absolutely do not need to solve this. The concept behind it all is actually way more straightforward, and we can break it down into a few simple steps.
Here it is, the simple three-step recipe. First, the system selects a whole bunch of different S&P 500 put and call options. Second, it calculates the expected volatility for two different but close time frames. And finally, it blends those two numbers together to create a really precise weighted average. That final number, that's the VIX.
Okay, so we know what it is, we know how it's made, but why should you actually care? How do investors and traders use this thing in the real world? This is where it gets really practical.
The most important thing, the number one rule to know about the VIX, is its famous inverse relationship with the stock market. In simple terms, they tend to move in opposite directions, like a seesaw.
Just look at this. When the S&P 500 goes down, especially if it's a sharp drop, investors freak out, and they rush to buy options as protection. That huge demand for insurance drives up the price of those options, which in turn makes the VIX spike. That's why it's the fear gauge. Fear goes up, market goes down, VIX goes up. And on the flip side, when the market is calm and rising, the VIX just tends to drift lower.
And this relationship makes the VIX an incredibly valuable tool. You can use it to gauge the mood of the market. Are people feeling confident or anxious? It can help you diversify your own portfolio. And you can even use strategies to hedge, which is just a fancy way of saying you're buying some insurance against a market downturn.
So the crucial takeaway is this. While everyone calls it the fear gauge, it's probably better to think of it as an information gauge. It's not just a reflection of pure panic. It's a really sophisticated summary of the market's collective wisdom about what's coming next.
And that's the VIX demystified. It's not magic, it's just math. A powerful forecast built from the market's very own bets. So now that you know how to read the weather report, the big question is yours to answer. What is the fear gauge telling you today?